Good evening, everyone. Welcome. Hi, I'm David Cowan, president of the museum, and this is Tartan Week, where all things Scottish are celebrated. Tonight, we're going to join forces with some old friends, the American Scottish Foundation. Heather Bain is here, Camilla Hellman is here, and some new friends, the University of Edinburgh Business School, and our new friend and partner on this event, Meta Fries, is here, so we want to welcome them. Now, you have bios on your seats of all of the panelists, but we have a surprise for you tonight, and that is Gabriel Surprise, the gentleman in the middle who, we don't know where Tom is, our moderator, and so we thought we should just get started. So if Tom does show, we'll pinch it, but Gabriel is very familiar with this space. He is a regulatory data analyst with our good friends over at the Stock Exchange, and you will see that he is also a qualified expert in the field. A few notes for us afterwards. Certainly please join us at the reception, and then please open your wallets downstairs at the gift shop, which will be open. And then lastly, when you leave, I want you to look directly up when you walk outside of the museum, because there is a Scottish flag flying in honor of Tartan Week and all other things Scottish. So take a look at that, and with no further ado, I am happy to turn it over, and thank you, Gabriel.
Absolutely. Well, thanks for having us here. I appreciate the introduction. It's a particularly honor to me because as someone with half Scottish background, this is a great opportunity to celebrate a Scottish-American relationship, and this is a great group of panels that we got here today. So yes, I'm guest speaking and moderating this, so treat me nicely. I appreciate that. So the topics I guess we're going to go through today: electronic trading, volatility, and fairness. We've got a great panel of people up here today that I think can speak to a number of topics as it pertains to particularly the idea of fairness and how does the evolving shift in markets and trading to an electronic platform or away from necessarily human contact or human-human interaction. How does that bring implications, and how does that affect the way in which business takes place from an integrity perspective, from a fairness perspective, and I think also how does that really impact volatility as it pertains to the market moving forward. So I guess we want to start off with a brief introduction about ourselves. Pat, do you want to go and cycle through?
Pat McCarthy from ICAP. I'm the managing director for government affairs, and I've been in the financial services arena mostly as a regulator for the last 25 years. I've spent a little time up on Capitol Hill. I've worked at the SEC and the CFTC and 4 different banking regulators, so kind of done a good trip around the world, and happy to basically talk. Wonderful to be here and help talk on these issues, and I guess I'll turn it over to my next panelist to introduce himself.
Hi, I'm Bill Nichols, Cantor Fitzgerald. Been at Cantor for 7 years now, and currently in the business development role, but I grew up on the sales and trading side. Been doing this for 25 years at various firms. Prior shops included Bear Stearns, Credit Suisse, and Goldman Sachs. And so I've been an active participant in the market, but I've also spent time in the buy side and spent some time in DC as well with the regulators and market structure side of things as well. So I have kind of a unique view of things from all sides. So it's nice to be here. Thanks.
Fantastic.
Thanks very much. My name is Benga Bikunle, GB for short. I'm an assistant professor in financial markets at the University of Edinburgh. My research interest is financial markets microstructure, basically. I examine the trading dynamics of securities as they trade on European stock markets. And my focus for the past few years has been the FTSE 350 stocks, which are the 350 largest firms in the UK.
Good evening, everybody. Matt Trudeau. I'm the head of product and strategic ventures at IEX. For those who are unfamiliar with the firm, we're the marketplace that was featured in Michael Lewis's most recent book, Flash Boys. I've been with the firm for about 3 years, since before Michael Lewis was involved and before we had raised a lot of money. Prior to that, I worked for a number of firms launching venues, equities trading venues globally. So I've been in the business now for about 16 years, and I've launched markets in the US, Europe, and Asia. Chi-X Canada, Chi-X Japan, Chi-X Australia, Chi-East were all markets that I was either responsible for or participated in the launch of. So I've seen a lot of the market structure and a lot of the rules and technology evolution around the globe.
Fantastic. Okay, I guess to kick things off, I know a hot topic in the news recently has been IEX, and I think that the arguments on both sides of the aisle for the regulatory approval, but also generally the concept that you guys are pioneering has big implications moving forward in markets as they exist on a high-speed basis. Would you want to talk a bit about how you guys view this as impacting the idea that in a high-speed world we can maintain integrity, but also perhaps focus on maximizing efficiency and delivering value for the customer?
Sure. So I would start by saying that, I mean, the market's evolved quite a lot. So when I started about 16 years ago, we were still, in some cases, writing paper tickets, a pink one for a sell order, a green one for a buy order. Direct market access was a brand new thing. The idea that you could send an electronic order from your desktop down to the floor and get a trade executed was something that was new and novel. Now we're talking about a lot of the argument about our exchange application. We've got an exchange application in with the SEC now to become a fully licensed U.S. securities exchange. The argument centers around 350 millionths of a second. So we went from paper tickets to 350 millionths of a second in the span of 16 years, which is a pretty remarkable thing. And when I look back on how the role that technology has played in the market, technology is inherently neutral. It's what you do with the technology that really determines the outcome. And so when we look at, especially in the last 10 years in the US, at the intersection of regulation, business practices, and technology evolution, some of the rules that were put into place back in 2005, 2006 have had some unexpected and potentially unintended outcomes. And the market has, over that course of time, through iteration, really started to focus more on the participants that care about speed. So the exchanges, for example, have a product suite now that is relying upon high-speed data products and high-speed access products. And we think that the market, at least in the US, in some ways has lost sight of the ordinary or traditional investor. And so part of what we're trying to do as a venue is take the pendulum and swing it back a little bit towards the other direction. Not to say that the technology and the evolution is bad, because in many cases it's reduced costs, it's brought greater efficiency, it's made the market better in many ways. So this is an opportunity for us to try to look at what we got right, what we could improve, and see if we can make some of those improvements.
Fantastic. Let's see, Pat, you're on the regulatory side. How does this play into the idea that in a high-speed world we can still maintain a grip on regulating these products as they're traded with increasingly higher speeds, but also in an effective capacity where we're still giving that value to shareholders, or excuse me, to investors, and we're capable of understanding what is exactly happening from a regulatory perspective and keeping up with that technology?
Well, I think it's kind of interesting, the speed issue, some people think that high-speed trading is actually, there's something wrong with that. I kind of think that that's not really the right approach. Electronic trading is a fact. It's been around since early 2000s, and in fact is about 80% of the market. If you're talking about the equity space, I think that's true. If you're in the FX space, in terms of spot, it's probably higher than that. And when you look at U.S. government bond trading, it's probably north of 50%. Futures, it's probably 70%. So it's something that's here, and I guess the thing is, it's a question about whether the regulators are keeping an eye on it and making the markets remain fair. And I think that to the extent that you're talking about a market that is fair, I think the regulators have to be able to view things almost in real time and be able to actually have audit trails to determine whether people are doing things wrong. And that's one reason why there are things in the law now against spoofing banging in the close, and other things which are ways of manipulating the price. I mean, it's kind of interesting because people would always say, well, listen, manipulation is wrong, and that's absolutely true. It's just that in the digital/electronic age, there's different ways of manipulating things. And I think, the regulators are usually few steps behind, but I think they're trying to make the market fair. And I think most electronic trading firms, and in fact, let's be very clear about this, hedge funds, banks, asset managers, insurance companies all do electronic trading. It's not like there's just a group of hedge funds that are the only people who are using algorithmic trading strategies. All of the major players use it today, so it's not just a particular group of people. That's what the markets have turned into. So I think it's more of a challenge of making sure that everybody's playing, you know what the rules are, you understand what's okay and what's not, and that the market regulators, the exchanges, such as the one you work for, have to be able to view this in real time and be able to basically correct people who are doing things wrong. You've got to maintain fairness in the markets. If you don't, then you lose investors' confidence in it, and you lose your market.
I think one thing to jump in, fair is very important, but also in the old days when you were talking about the specialists trading on the floor, it was fair and orderly, right? So the orderly part is the second part of the puzzle, and where that comes into play is fair, everybody's treated fairly, I think people know what that means, but orderly is if you have a one-directional move or all of a sudden there's cascading sell orders and you have huge volatility in sort of a small amount of time, who's there to provide the other side of that market, right? And there you actually benefit from having more players. The more people that are involved in a market, the more inherent bids and offers there are, and that'll dampen volatility a little bit. So I think with all the rules about maintaining fairness, that's important, but the more players that you have in the marketplace, it dampens volatility. And a lot of these electronic strategies, which are really just there to make money, they're not touching a mutual fund or someone in the investing public, they're just strategies to make money for that market-making organization. People look at that as what used to be going on with the specialist. The specialist was there to make money because when times were not good, they had to be the only bid and offer in sort of these small and mid-cap names and provide an orderly market as well. And that sort of tacit, you're going to profit from this bigger group of stocks to sort of be there as the buyer or seller of last resort and these smaller ones to make a market, and there was a quid pro quo. Now that's done electronically and diffused, but the more you want a deep market, you don't want to have just one player. So that's the balance, and that's sort of the counterpart to the fairness as well.
Tom Easton has arrived. We want to thank Gabriel Surprise. That was phenomenal. We really appreciate it.